Look, the only thing that makes sense with revaluing our gold reserves is if we go back to a gold standard, and we need to have a gold price at which we can back our currency. And that is a price in the tens of thousands, many tens of thousands of dollars an ounce to do that. Or if we want to use our gold to pay down our national debt, we need to devalue the dollar dramatically, because even if we sold all of our gold, if our gold is not even $1 trillion and we use it to pay off our national debt, we wouldn't even pay off, 4 months worth of it? We got the numbers that came out today for the Treasury. They came out with their statement for the monthly deficit. Look at these numbers. So for January of 2025, the expectation was for an $89.9 billion budget deficit. These are the official numbers, right? The actual national debt grows by more than that, because all the off-budget stuff isn't even recorded in these official numbers. So they were looking for $89.9 billion. We got $128.6 billion in 1 month. It's a 40% increase in the prior month, but year over year, it's a 500% increase. The budget deficit in January of 2024 was $22 billion. It's $8.6 billion in January 2025. What does that tell you is likely to happen for the rest of the year? 2025, I think, is going to be the biggest annual increase in the national debt in history. But the record won't last long, because we're going to break it in 2026, right? Doesn't matter about what Doge cuts. I'm tired of hearing Doge is going to solve that. Doge is going to fix that. There are certain things that Doge is going to do. Expose corruption, maybe put some people in jail, people who have been getting rich criticizing Trump. And the Republicans spend all their time criticizing Biden. Biden this, Biden that, right? But nobody is dealing with the actual problem, the debt, the ticking time bomb. Again, he keeps saying that the debt isn't a problem, but the path is. He says we're on an unsustainable path. Well, but that means the debt is a problem, because the debt is on that path. I mean, you can't really separate the debt from the path, because look at the path, right? It's continuous and it's growing exponentially. And we can't wait until we get to the point where, there's a crisis. I mean, that's basically what Powell is talking about when he says that we're on an unsustainable path, but we're okay right now. So again, you jump off the top of the Empire State Building, and on the 50th floor on the way down, you're on an unsustainable path. But clearly, you're headed for disaster, right? You can't say it's, I don't have to worry until I hit the pavement, because once you splat on the pavement, that's it, right? There's nothing you could do, right? So Powell, we don't have to worry about the unsustainable debt because we're not on the pavement yet. We only have to worry about it when we have a full-blown crisis. Well, no, by then it's too late. You can't do anything about it. You have to worry about the problem when you can still do something to fix it. You can't just say, well, we don't have to worry about it because it hasn't blown up in a complete unmitigated disaster yet, right? Well, by then, it's too late to do anything. You are done. So he should be doing everything he can to get us to do the right thing now, which would be hiking interest rate and warning about what's going to happen. But no, he doesn't do any of that. People kept asking him, what do you need to see before you start cutting rate? Nobody said, well, what do you need to see before you start hiking rate? Nobody talked about the potential for rate hikes. And in fact, Donald Trump himself set the stage even before we got the CPI number. We need rate cuts now. He said we need them to go along with the tariffs. He said it's time for America to rock and roll. Rock and roll with rate cuts. We can't have rate cuts. Trump campaigned to get rid of inflation. Well, we want to get rid of inflation. We need rate hikes, not rate cuts.
The debt mountain continues to grow at an uncontrollable pace, yet those in power refuse to take decisive action. The Federal Reserve, which should be a watchdog for fiscal responsibility, is instead a facilitator of reckless government spending and monetary debasement. The very idea that inflation is under control is a fantasy, one that central bankers and politicians continue to push on the public to maintain the illusion of stability. Meanwhile, the real economy is screaming otherwise. The cost of living is rising, savings are eroding, and the so-called soft landing that Jerome Powell keeps promising is nothing more than a stall tactic before the inevitable collapse. The bond market is sniffing this out already, Treasury yields are climbing higher, and mortgage rates have surged past 7%. Even credit card rates have soared into the 20 to 25% range, making it impossible for the average American to escape the crushing weight of debt. With an economy built on easy credit and cheap money, the rising cost of borrowing is squeezing consumers and businesses alike. Companies that have relied on artificially low interest rates to fund their operations are now facing a harsh reality. Debt service costs are skyrocketing, and the days of easy money are over. But the Federal Reserve refuses to acknowledge the depth of the crisis. Powell continues to insist that inflation is on track to return to 2%, despite every leading indicator pointing to persistent inflationary pressures. Commodity prices are surging, wages are rising, and fiscal spending remains out of control. Yet in their latest meeting, the Fed remained non-committal, dangling the possibility of future rate cuts while refusing to admit that inflation is still a serious problem. The market, which had been banking on aggressive rate cuts, is now starting to panic as it realizes the Fed may have no choice but to keep rates elevated longer than expected. And then we have Trump, who is pushing for rate cuts alongside tariffs. His economic plan calls for a return to protectionism, which may sound great for domestic manufacturers, but will ultimately fuel inflation even further. Higher tariffs mean higher prices for consumers. Combine that with a weakening dollar, and you have the perfect recipe for an inflationary storm. So, what does all of this mean? It means that the average person is going to pay the price for the government's incompetence. And that's where gold comes in. Gold has always been the ultimate safe haven in times of economic uncertainty. Unlike fiat currency, which can be printed at will, gold is a tangible asset with intrinsic value. Central banks around the world recognize this, which is why they have been aggressively accumulating gold for years. China, Russia, and other nations are moving away from the dollar and increasing their gold reserves as a hedge against the inevitable collapse of the fiat monetary system. And yet the average investor in the United States remains woefully underexposed to gold. Historically, precious metals have accounted for about 2% of total investment assets. Today, that number is less than 0.5%. The mainstream financial media continues to push the narrative that gold is an outdated asset, but history tells us otherwise. The last time we saw sustained inflation and monetary debasement, in the 1970s, gold prices skyrocketed. Between 1970 and 1980, gold went from $35 an ounce to $850, an increase of over 2,300%. Adjusted for today's economic conditions, we could see gold easily reaching $10,000 or more per ounce in the coming years. This is why it's crucial for investors to position themselves now before the real crisis hits. Once the general public wakes up to the reality that their savings are being systematically destroyed, there will be a mad rush into gold. By then, it will be too late to buy at reasonable prices. Those who wait will be left scrambling, while those who were prepared will be sitting on a fortune. Silver, too, is massively undervalued. The gold-to-silver ratio remains near historic highs, meaning that silver has far more upside potential relative to gold. As inflation accelerates and industrial demand for silver increases, we could see silver outperform gold significantly. And yet silver remains the most overlooked asset in the market today. It is gold's more volatile cousin, with the potential for explosive gains when monetary crises unfold. The writing is on the wall. The U.S. government is drowning in debt, the Federal Reserve has lost control of inflation, the bond market is in turmoil, and the global monetary system is shifting away from the dollar. The smart money, central banks, institutional investors, and those who understand history is already moving into gold. The question is, will you do the same before it's too late?
We need the Fed to pick up the pace of its quantitative tightening, but it's not going to do that. And in fact, the Fed talked about how it's going to continue to do that. He was asked again about QE or when might they do that, and he pointed out, well, we only do that once we get down to the zero bound. And he said, so we're not at the zero bound. And I thought they might, break from that recent tradition, because I know there's going to be a lot of upward pressure on long-term interest rate. Once they get above 5%, the 10-year hits 6%. The only way the Fed could, put some brakes on that without sharply increasing interest rates, which they don't want to do, would be to go to QE. But I don't think they want to slash interest rates to zero and then go to QE. So I think the next time they do quantitative easing, it's not going to be when they're at the zero bound. They're going to do it well before. I don't think we're going to be able to reduce rates to zero in the face of this high inflation. They were able to do it when inflation was below 2%. It's not going to go below 2%, even if we're in recession. In fact, the recession is going to be caused by rising inflation and rising interest rate. And so they can't cut rates anymore. Again, that's why stagflation is not one of the scenarios that they stress tested, because all the banks fail. And that's why they have no contingency plan. That's why all they can do with respect to stagflation is hope it doesn't happen, because the Fed knows that there's nothing in their playbook for stagflation, right? It's game over. And so they just want to, close their eyes and hope it doesn't happen.
Expanding on Schiff's insights, we delve into the structural and geopolitical shifts that underscore the case for gold and silver. While the immediate market reaction to a Trump presidency might seem bearish for gold, this short-term perspective ignores the broader, long-term factors that make precious metals indispensable in the current economic environment. One of Schiff's key points is the ballooning U.S. national debt, now over $33 trillion and climbing. A second Trump term would likely exacerbate this issue, as his proposed policies, tax cuts, increased defense spending, and infrastructure investments would significantly expand the fiscal deficit. Schiff points out that servicing this debt at higher interest rates will be a Herculean task, requiring even more borrowing and ultimately money printing. This creates a vicious cycle where the dollar's purchasing power erodes, making gold's role as a store of value more critical than ever. Schiff describes gold as a financial lifeboat, a safe haven asset that becomes indispensable when the economic ship starts sinking. Historically, Schiff reminds us, gold has proven its worth in similar scenarios. In the 1970s, the dollar lost 75% of its purchasing power, and gold skyrocketed from $35 to $850, an astronomical 24-fold increase. More recently, during the 2000s, gold rose from $253 to $1,700 as the dollar faced internal challenges. Schiff uses these examples to highlight gold's ability to retain and even grow its value during periods of economic turbulence. These historical trends are not mere coincidences. They are a reflection of gold's fundamental role as a hedge against currency devaluation and systemic risk. Schiff's analysis also extends to the geopolitical landscape. The global move away from the US dollar as the world's reserve currency is accelerating, with central banks around the world increasing their gold reserves. Schiff argues that this trend is driven by a lack of trust in the dollar-dominated financial system. While markets speculate that Trump's tough stance on trade and tariffs might slow this trend, Schiff contends that the underlying distrust in the dollar will only grow. Countries like China and Russia are already leading the charge, seeking to de-dollarize their economies and reduce their dependence on U.S. financial systems. Gold, as a universally accepted and non-politicized asset, becomes a natural choice for these nations. Another dimension of Schiff's argument is the impact of immigration policy on the U.S. economy. Trump's proposed mass deportations, while politically appealing to his base, could have severe economic consequences. Undocumented workers fill critical roles in industries like agriculture, construction, and hospitality. Removing these workers would strain an already tight labor market, driving up wages and production costs. While this might sound like a win for American workers, it would also exacerbate inflation, a development that Schiff sees as bullish for gold. Higher costs for businesses and consumers would reduce purchasing power, making gold an even more attractive hedge against inflation. Schiff also critiques Trump's trade policies, particularly his reliance on tariffs. While tariffs aim to protect domestic industries, they often end up being a tax on consumers. America's dependence on imports means that tariffs merely increase the cost of goods without addressing the root causes of trade imbalances. Schiff warns that tax cuts, coupled with increased consumer spending, would worsen these imbalances, driving up inflation and further weakening the dollar. In this scenario, gold would not just be a safe haven, it would be a necessity for preserving wealth. Turning to the broader investment landscape, Schiff highlights the disconnect between market optimism and economic reality. The stock market's current buoyancy, fueled by speculative exuberance, belies the underlying weaknesses in the economy. Schiff draws parallels to previous bubbles, such as the tech bubble of the late 1990s and the housing bubble of the 2000s, both of which ended in financial crises. In such environments, gold and silver emerge as reliable alternatives to overvalued stocks and bonds. Silver in particular holds a unique position in Schiff's analysis. While often overshadowed by gold, silver's dual role as a monetary and industrial metal gives it additional layers of demand. The rise of renewable energy technologies, such as solar panels, is driving a surge in silver consumption. China, for instance, has been aggressively acquiring silver resources in Central America, paying premium prices for raw silver ore to fuel its green energy initiatives. Schiff argues that this industrial demand, combined with silver's historical role as a monetary asset, makes it a compelling investment. During previous bull markets, silver has often outperformed gold in percentage terms, and Schiff sees no reason why this trend won't continue. Schiff also addresses the psychology of investing in precious metals. Many investors view gold and silver as speculative assets, hoping to capitalize on short-term price movements. However, Schiff emphasizes that precious metals should be seen as long-term insurance policies against systemic risks. The goal is not to time the market perfectly, but to secure financial stability in an increasingly unstable world. Schiff warns against waiting for the perfect moment to buy, as market conditions can change rapidly. By the time the masses realize the importance of owning gold, it will be too late, he cautions. Central banks' recent gold-buying spree underscores Schiff's point. These institutions are some of the most informed participants in the financial system, and their actions speak volumes about the state of the global economy. Schiff sees their accumulation of gold as a clear signal that the dollar's dominance is waning. For individual investors, this trend is a wake-up call to follow the lead of central banks and secure their own holdings of precious metals. Schiff also challenges the perception that higher interest rates are inherently bad for gold. While rising rates can increase the opportunity cost of holding gold, Schiff argues that the broader context matters. In today's environment, where real interest rates remain negative when adjusted for inflation, gold's appeal remains strong. Negative real yields erode the purchasing power of cash and bonds, making gold an attractive alternative. Schiff describes this as a silent tax on savers, one that gold can help mitigate. In conclusion, Schiff's analysis paints a compelling picture of gold and silver as essential assets in today's economic and geopolitical landscape. Whether the trigger is inflation, currency devaluation, or geopolitical shifts, the case for precious metals is stronger than ever. For investors, the message is clear. Gold and silver are not just investments. They are lifelines in a sea of economic uncertainty. As Schiff aptly puts it, gold is the only real money. Everything else is just credit.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.